What if I told you the reason the United States has been able to borrow trillions of dollars, live far beyond its means, fight endless wars, and still avoid collapse, is tied to a secret pact, not with gold, but with oil? Imagine that behind every barrel of oil sold, there was not just energy, but a hidden pipeline fueling the U.S. economy, propping up its currency, and granting decades-long privileges. But now, that pipeline is starting to crack, and if it breaks, the consequences could shake the foundation of global finance. Today, we dig into that hidden pipeline. Today, we trace how the petrodollar system, the mechanism that for nearly half a century gave America what amounts to a free lunch, is unraveling. And we explore what that unraveling might mean, not just for the U.S., but for the world economy. But first, some context. To understand why the petrodollar system mattered, we need to go back to the early 1970s. After World War II, the global monetary system was largely defined by the Bretton Woods system. Established in 1944, under Bretton Woods, many currencies were pegged to the U.S. dollar, and the dollar itself was pegged to gold at a fixed price per ounce. This meant foreign governments didn't need massive gold reserves of their own. They could simply hold dollars. For a time, this system kept global trade stable, with the dollar as the anchor. But by the late 1960s, a problem emerged. U.S. spending on social programs, military commitments, and foreign obligations ballooned. The supply of dollars surged relative to the gold backing them. Other countries began to get nervous. Many started demanding their dollars be converted into gold. That pressure forced a fateful decision. On August 15, 1971, Richard Nixon suspended the dollar's convertibility to gold, a move now known as the Nixon shock. The old Bretton Woods arrangement collapsed. The dollar was no longer tied to any tangible commodity. It became, officially, a fiat currency, valuable only because people agreed it is. Suddenly, the world faced a dilemma. If the dollar was no longer backed by gold, what would ensure its global dominance? Enter oil. Enter the producers. Enter a new secret agreement. Origins of the petrodollar. How oil became dollarized. Fast forward a couple of years. The world was reeling from change. The 1973 oil shock triggered by geopolitical tensions, and an oil embargo led by the Organization of the Petroleum Exporting Countries OPEC, sent oil prices skyrocketing. For oil exporting countries, this meant enormous revenues. But what currency would they hold those revenues in? Their own currencies were often volatile. Gold was no longer the default. The answer came through diplomacy, geopolitics, and pragmatism. The United States struck a deal with Saudi Arabia and through it, indirectly, with other major oil producers. Oil would henceforth be priced and transacted in U.S. dollars, not in gold, not in pounds, not in foreign currencies. In return, Saudi Arabia and other oil exporters would reinvest their vast dollar revenues, petrodollars, into U.S. financial assets, especially treasury bonds, and the U.S. would offer military and economic support to those same oil exporters. This arrangement, the birth of the petrodollar system, did not require every country to formally sign a global pact. It functioned via mutual incentives. Oil exporters wanted stable, liquid, globally accepted currency. The U.S. wanted a reliable sink for its growing budget deficits. What resulted was a reshaped financial ecosystem. Oil gives dollars, gives reinvestment, gives cheaper U.S. borrowing, gives more spending, military, social, international. The petrodollar became the engine of U.S. economic dominance. By the mid-1970s, the shift was dramatic. Countries that historically traded oil in pounds or other currencies abandoned them. Dollar became the standard. Rise. How the petrodollar fueled American hegemony. With petrodollars flowing in, the U.S. gained an enormous structural advantage, what economists sometimes call its exorbitant privilege: cheap borrowing and financing deficits, because oil exporters recycled their dollar earnings back into U.S. Treasury bonds. The U.S. had a ready and willing pool of international capital. That meant the U.S. government could issue debt, lots of it, at relatively low interest rates. No need to raise taxes, no need to tighten budgets. The U.S. was effectively borrowing from the world's surplus petrodollar wealth. This allowed unprecedented government spending on infrastructure, social programs, defense, global military reach without the immediate fiscal pressure other countries would face, dollar hegemony, and global reserve status. Because oil, the lifeblood of modern economies, was denominated in dollars, other nations needed to hold dollar reserves. This guaranteed perpetual demand for the dollar. It didn't just keep the U.S. afloat, it made the U.S. the cornerstone of global finance. International financial institutions, trade contracts, global debt markets, nearly all hinged on the dollar's dominance. The petrodollar system reinforced and institutionalized this dominance, influence, and geopolitical power. The recycling of petrodollars into U.S. assets also translated into geopolitical leverage. Countries with oil wealth were incentivized to cooperate with U.S. policy, military deals, arms sales, defense collaborations, strategic alliances. The U.S. effectively traded protection and investment for loyalty and dominance that extended far beyond economics. In short, petrodollars didn't just fuel cars, they fueled empires. Breaking point: why the system is cracking, but nothing built on convenience and mutual incentive lasts forever. Over decades, pressures have been building that threaten to crack the foundation of the petrodollar system. Dollar overhang and structural U.S. deficits. The model depended on continuous reinvestment of petrodollars into U.S. debt. But as U.S. deficits ballooned, driven by military spending, social programs, financial bailouts, and rising obligations, the size of U.S. debt far outpaced the real value that dialysis could be sustainably backed by oil export reserves. Eventually, the recycling flows would strain under their own weight. Diversification and shifting geopolitical alliances as global economies diversified new oil producers. Shifting alliances, new financial powerhouses, some oil exporting countries began exploring alternatives to the dollar. The logic was simple. Why remain tethered to U.S. monetary policy and financial dominance when you could diversify into other currencies or assets? Moreover, global power dynamics changed. Countries like China and Russia grew economic influence. Some states began to quietly explore trade and oil transactions outside the dollar-based system. Structural contradictions, fiat dollar and oil dollar mismatch. Remember, dollar was no longer backed by gold, was a fiat currency. Its value rested largely on confidence, institutions, and worldwide demand. But that demand rested heavily on oil being priced in dollars. If that link weakened, the dollar's global foundation became shaky. In short, the very mechanism that sustained U.S. dominance had become a long-term liability. Fallout: what happens when petrodollar recycling weakens? As the system begins to strain, the consequences ripple across finance, geopolitics, and global stability. Higher borrowing costs for the U.S. if oil exporters stop recycling petrodollars into U.S. debt. Foreign capital dries up. That means less demand for treasuries. U.S. would have to attract other buyers or raise interest rates. Higher interest rates mean more expensive borrowing, hike in debt servicing costs, pressure on budgets for defense, social programs, and infrastructure. The free lunch starts getting expensive. Decline of global dollar demand, weakening reserve status. If oil and other commodities shift toward being priced in other currencies, for example yuan, euro, local currencies, then demand for dollar reserves declines. Countries will hold fewer dollars. That means less global liquidity in USD, less leverage for us, and increased volatility in currency and commodity markets. Geopolitical realignment and economic instability for oil exporters. Oil exporters who once enjoyed safe dollar-denominated wealth might find themselves exposed. Without guaranteed dollar demand, their reserves lose value. Their investments, often in U.S. assets, shrink. Their political leverage may diminish. As global financial flows shift, some regimes could face instability or economic pain. Impact on global financial markets and emerging economies. Because the petrodollar system underpinned massive capital flow, its weakening could trigger global credit tightening. Emerging economies, especially those with dollar-denominated debt, could face currency risk, inflation, debt crises. The global financial system could redraw itself around new centers of power and new reserve currencies. In short, the fallout wouldn't be just America's problem. It could ripple worldwide. Failed fixes attempts to salvage the system and why they might not work. As cracks spread, various attempts have been made to preserve or adapt the system. But so far, many of those attempts run into structural contradictions, reaffirming dollar-based oil pricing. Some defenders of the petrodollar system argue, just keep pricing oil in dollars. As long as oil remains dollar-denominated, demand for USD remains. That's the easiest and perhaps most obvious fix. But this fix leans heavily on political will, not on economic fundamentals. As more countries build reserves in other currencies, invest outside US, or conduct bilateral oil deals bypassing USD, the leverage to enforce dollar pricing weakens. Oil exporters may resent being overly exposed to US monetary policy or US sanctions. Moreover, global energy markets are changing. New producers, renewable energy. Shifting demand, dollar pricing becomes more brittle. Diversification into other assets, more complex recycling. Even if oil remains in dollars, some surplus petrodollars are being directed into non-US investments, foreign equities, sovereign wealth funds investing globally. Gold. This reduces pressure on US financial markets to absorb all surplus capital. But this is a workaround, not a fix. It chips away at the core link. Oil gives dollars, gives us treasuries. It weakens that feedback loop. Shift to alternative currencies, petróleo and petroro, or local currency pricing. Some oil-importing nations and oil-exporting nations have discussed pricing oil in other currencies. For example, proposals for a petróleo yuan tied to the Chinese yuan. This represents a fundamental break with the petrodollar era. If enough countries adopt this, the global demand for dollars, at least for oil trade, could shrink dramatically. But this transition faces many obstacles. Trust in currency convertibility, existing financial infrastructure, hedging markets, and the inertia of decades of dollar-based contracts. Still, it is among the most dangerous challenges to the old petrodollar paradigm. Modern parallels and warning signs why we might be near the end. So, what's happening today that makes this theory less hypothetical and more real? Evidence of de-dollarization and shifting alliances. Over the past few years, there has been increasing talk among oil exporting and oil importing countries about reducing reliance on the US dollar. Some are negotiating oil sales and trade in alternative currencies. Others are investing their reserves outside the US debt markets. At the same time, major economies outside the US with growing influence and financial infrastructure are offering alternatives to dollar-based finance. Emerging power centers challenge the monopoly of dollar-based global finance. Structural debt and fiscal imbalance in the U.S. The U.S. federal debt continues to climb. As deficits grow, reliance on foreign capital becomes more precarious. If foreign buyers, especially those once guaranteed by petrodollar recycling, start withholding demand, the cost of U.S. borrowing will rise. That threatens interest rates, inflation, and economic stability domestically. Commodity markets and energy transition. Global energy demand is shifting. Renewable energy, changing consumption patterns, and new energy producers all erode the centrality of oil. As oil's dominance fades, so does one of the main anchors of dollar demand. If energy trade becomes more diversified, the logic for a single global reserve currency pegged to oil becomes weaker. A changing financial ecosystem. Global finance is evolving. New institutions, new currencies, new trade corridors, and technological shifts, digital currencies, alternative payment systems all challenge the old norms. The financial rules of the game may be rewritten, and the petrodollar system, born in the 1970s, may not survive the rewrite. Why this matters: the hidden free lunch is ending. For decades, the petrodollar system allowed the U.S. to essentially consume the world's resources, borrow with impunity, and project power globally, all with minimal direct cost to itself. Oil for dollars created perpetual demand for the dollar. Dollar demand funded U.S. deficits. Deficits financed global power. It was a self-reinforcing loop, a hidden free lunch. But if that loop breaks, the consequences are profound. Higher borrowing costs, loss of currency dominance, reduced global influence, economic instability, not just for the U.S., but globally. For oil-exporting nations, shrinking demand for dollars and their reserves would threaten wealth accumulated over decades. For investors in emerging economies, volatility, currency risk, debt danger. For global markets, a possible reordering of financial alliances and power centers. 3 key takeaways. 1. The petrodollar system was not an accident. It was a carefully constructed financial geopolitical infrastructure. Born out of the collapse of Bretton Woods, shaped by the 1973 oil crisis, and cemented through strategic alliances. Petrodollar recycling enabled the U.S. to borrow massively and wield global influence. 2. That infrastructure is showing cracks, structural debt. Shifting alliances and global economic evolution are eroding its foundations. As some countries diversify away from the dollar, and oil loses its central dominance, the perpetual demand for dollars is no longer guaranteed. 3. If the petrodollar system collapses, the consequences will reverberate worldwide, and we may already be seeing the early tremors. Higher U.S. borrowing costs, weaker dollar hegemony, financial instability for oil exporters, and a possible reshuffling of global power dynamics. A warning or an open-ended thought. Perhaps the biggest danger isn't a sudden collapse, but a slow, grinding erosion. A world where the dollar gradually loses ground, where oil trades slip toward other currencies, where capital flows diversify, and where the U.S. loses its extraordinary privileges bit by bit. That process could unfold quietly over years, but its effects would still be huge on interest rates, on the value of savings and investments, on global stability, on who sets the rules. If the petrodollar's death is a slow fade instead of a dramatic collapse, many will realize too late that the free lunch ended long ago. Call to action. If you found this story surprising or disturbing, take a moment to think about what it means for global finance, for oil-producing nations, for your own savings or investments. Share this video with someone curious about global economics. And if you want to go deeper, hit subscribe to join me as we explore financial history, power dynamics, and what the next 10 to 20 years might bring. Because if the petrodollar era really is ending, we're reliving through one of the greatest shifts in global monetary history. And the world that follows may look very different.